you can see here that there's elements of this that are really important to look at that I think are really important from a banking perspective. You know, when we look at the principles of the policy and the design and kind of some of the features that we're looking for the dump in that possible. We want to look at the annual premium, and then we want to look at the increase in net cash value, right? So the increase in net cash value going into this, you actually are basically breaking even year 5, which is really hard to do. Hey, what's going on, cash flow hackers? This is Chris with Life 180. In this video, I'm going to be answering some questions that I've been getting from some viewers and followers about if you are older, are you able to get life insurance? Right? Does infinite banking, does whole life insurance make sense for you if you're in your 60s, for instance? And so the answer is it depends. And there's some variables that come into play as to whether I believe it's a good fit for you or not. Leveraging life insurance as you get older in life obviously comes with different considerations. As you're older, obviously, the mortality costs and the insurance charges are going to be higher. However, if you do it right, and if you're leveraging the policy in the right way, and I'm going to get into this, it can still be a really phenomenal opportunity for you. Especially if you want to utilize it for real estate, if you want to utilize it for an emergency fund, the principles don't change. It's a way to get your dollars to perform more than one function in your life for you. And so these are all things that we can pull off. Here's the deal. How much money you come to the table with is going to have a big impact on whether or not I think this makes sense from a banking perspective. As somebody who is looking at getting a policy on the front end, if you don't have a front load to put into the policy, the liquidity of your policy can actually kind of be not so attractive, right? And so on the flip side, if you have some money that you can come to the table with and front load the policy, and I'm going to show you what that looks like, it can be a really phenomenal thing. So what I had one of my guys put together an illustration for me on what this could look like, and I just put it together. So let's just go through it and get into it. All right, so you can see here that I have a 60-year-old. The annual premium is $6,326 with a $58,000 lump sum. So that is all really good stuff. So you can see you combine these two numbers, it gets to the first year premium of $64,621. That is how much you put in between the front load and the annual premium. And you can see here with this is leverage. Now, if you believe that you need to have this money liquid, accessible, and controllable, you're talking about you're going to have $57,000 liquid out of that $64,000 right away. You're going to pick up $674,000 of life insurance. Now, most people, when they're buying this, are buying or utilizing these policies and depositing the money into these policies because of the fact that they want the liquidity of the money. And that is their first and foremost thought. At the same time, as we get older, obviously, the idea of our legacy, the idea of our estate planning and our wills and everything that we're doing to try to pass on to the next generation is more of a consideration. And so you can see here that there's elements of this that are really important to look at that I think are really important from a banking perspective. You know, when we look at the principles of the policy and the design and kind of some of the features that we're looking for the dump in that possible. We want to look at the annual premium, and then we want to look at the increase in net cash value, right? So the increase in net cash value going into this, you actually are basically breaking even year 5, which is really hard to do in a policy with somebody who's in their 60s. Now, you can only accomplish this by doing a front load, a massive front load into the policy ratio. Now, just for full transparency, this front load doesn't have to be the full $64,000. It just happens to be that the more you put into this policy on the front end of it, the more efficient the policy is going to be. If you cut the front load of the policy down from the $58,000 that we see up here, we would also want to make sure we reduce the premium a little bit on an annual basis to keep the efficiency, so to speak. And so you can see by year 5, we're basically, the policy is growing annually by more than we're contributing to it. And so that's a really, really good sign. And so as you can see here, you're picking up the life insurance. Now, what we did is we had a 7-year term rider. And so after 7 years, that term rider will drop off. And this is all about keeping the efficiency. Now, it's also really important to consider that when you are in your 60s, we want to keep the term rider as short as possible, because the later in life that they are insuring you on a term rider, let's say we had to do a 15-year term rider and they had to insure you until you're 75, it's going to be a little more expensive for a 15-year term rider. For a 61-year-old, it's actually going to be significantly more expensive than a 7-year term rider at 61, because the mortality costs and the risk to the insurance company is drastically higher for them. And so you have to think about that as we're looking at these variables. And so what we're looking at here, and this is just what I want to go down through here, is if you wanted to use this for real estate investing, let's say you wanted to find a $250,000 property. Well, year 2 or 3, you're going to have enough money in this policy to go out and get your first cash flow property. If that's something you wanted, maybe you wanted to use this for a down payment for a second home or something of that nature. Maybe you just wanted this for an emergency fund or an opportunity fund, or you just want to save your money and leverage your money and have it perform more than one function for you. And instead of keeping that money in a savings account, you want to keep it here because hey, this is going to outperform a savings account long term, and you're going to get this extra life insurance, and you're going to get living benefits. Let's actually go down and take a look at the living benefit statements, the accelerated death benefit rider. So this is another thing that we have to think about and take into consideration, especially as we age, we start to think about these things a little bit more. So what we can see here is there's a chronic illness rider to this, that you can have access to a portion of the death benefit while you're alive if you become chronically or terminally ill, right? And so you can see here that they will advance you. Let's say something tragic happens to you when you're 70. You're going to have access to $160,000 tax-free from the death benefit in advance while you're alive, to be able to, if you are diagnosed with 12 months to live or less. And so if that's the case, you get $160,000. You can utilize that for alternative treatments. It's just leverage. Same thing with the chronic, but you're talking about a little less money, $145,000 instead. And so once again, this is just leverage. You can utilize it for banking. You can utilize it for a lot of people look at this, since long-term care is getting really expensive. This is just another way to get those dollars that you need in those safe, liquid, accessible accounts to kind of help ease the burden a little bit for that risk. I'm not saying it's going to replace long-term care. I'm not saying it's going to solve all of your long-term care needs. So please don't take that statement as such. Just know that, if resources are limited, and these are the things that you're having to take into consideration from a planning perspective, those are some variables that you can kind of take into consideration. And so it's really clean at this point in time. I wanted to do this video and show you that if you are in your 60s, you can still leverage whole life insurance for you, for your family, to accomplish your goals and needs. What I would encourage you to do is, if you are somebody who's in that position, go ahead and look in the description in the link below. You can utilize that link to set up a call with one of my certified coaches that will be able to walk you through a clarity call to help figure out, what does it look like for you? What are your goals? What are your objectives? What does your cash flow look like? What are your liquid reserves look like? How would this fit into helping you solve some of the challenges and thoughts that you're having with your personal finances? And what I know is that this can be an extremely powerful tool and product if utilized properly, but it also is missold a lot of times for people who are in their, let's call it 60 and up, right? They are missold a lot of times. And so we want to make sure that you talk to somebody who's a professional that understands things the way that I coach it. And so if you want to talk to somebody, go ahead, set up your free clarity call down in the link in the description below. And that's it. If you have any questions, as always, leave them in the comment section below. I will do my best to answer. I try to answer every comment as I possibly can. And if you haven't already, make sure you subscribe, hit the bell, that way you get notified every time I launch a new video. And until next time, have a blessed and inspirational day. We'll talk soon. See ya.